In recent months, a growing number of analysts and seasoned investors have started to whisper a phrase that often makes markets uneasy: a market reset. But what exactly does that mean? And more importantly, is it already happening right now? While mainstream headlines may still focus on inflation, interest rates, and geopolitical tensions, a deeper look reveals subtle but powerful shifts beneath the surface of global financial markets. To understand the idea of a market reset, we first need to define it. A market reset doesn't necessarily mean a sudden crash like the one seen in 2008. Instead, it refers to a structural change in how markets behave, how assets are valued, and where capital flows. It's a transition phase where old trends lose strength and new patterns begin to emerge, often quietly, and often before the majority of investors even notice. One of the key signals analysts point to is the changing behavior of interest rates. For years, markets thrived in a low interest rate environment where cheap money fueled growth in stocks, real estate, and speculative assets. However, central banks around the world have shifted course, raising rates to combat inflation. This change alone has forced investors to rethink risk and return. Assets that once seemed unstoppable are now facing pressure, while safer investments are starting to look attractive again. Another important factor is the shift in market leadership. In previous years, a handful of big technology companies dominated the stock market, driving major indices higher. But recently, we've seen a rotation into other sectors such as energy, healthcare, and industrials. This kind of rotation is often a sign that the market is recalibrating itself, moving away from overvalued areas and redistributing capital into sectors with stronger fundamentals. Valuations are also under scrutiny. During periods of easy money, many companies traded at extremely high valuations based on future growth expectations. Now, with higher borrowing costs and economic uncertainty, those expectations are being questioned. Analysts are noticing that earnings projections are becoming more conservative. Liquidity, or the amount of money flowing through the financial system, is another piece of the puzzle. When liquidity is abundant, markets tend to rise as investors have more capital to deploy. But as central banks tighten monetary policy, liquidity begins to shrink. This can lead to increased volatility and sudden market movements. In conclusion, while the term market reset may sound alarming, it doesn't necessarily signal disaster. Instead, it reflects a natural evolution of the financial system in response to new economic realities.